Welcome back to the DJ the Money Coach Expert Interview Series. I'm Nick, joined as always by the founder of the Seven Spheres of Money, DJ the Money Coach. Welcome back, DJ. It's good to see you.
Likewise, you too, Nick. Hey, today we're actually going to flip the script. Normally I'm the interviewer, but now today I'm going to be the interviewee because we have a good friend of ours who's known as the electricity guy across the country that has an amazing following on LinkedIn. And he's actually going to ask me questions about how we can help people in the pandemic and how we can get people to become consumer debt free in 30 days or less. So without further ado, I want to introduce to everybody the electricity guy. I call him Riz, but I'm going to let him tell you exactly what his name is and what his platform. Welcome to the show, Riz.
Thank you very much, DJ. My name is Riz Nabi. I go by Riz. I have an electricity brokerage company based in Houston. We serve Texas market and also several other states. But I just wanted to get into the interview and ask a couple questions to you about what's going on currently with the COVID-19 situation across the U.S. One of my questions I had was right now I see a lot of news about interest rates going down, and I wanted to know what's going on with mortgage rates. Is it a good time to refinance your home?
That's a great question, Riz. On the surface, the answer would be yes. But before you do anything, you should consult with a professional. And let me tell you why. Let me give you an example. Some real life situations just occurred this past week with two members inside the Seven Spheres of Money Network. So typically people with A credit, like myself, probably the last time they bought a house or refinanced was 5-7 years ago. And they probably had a 3.75 interest rate, may have no higher than 4.75. But since the central bank lowered the rates down to 0 for the retail banks, we're now seeing that benefit come into the retail sector, Riz, where now you can get an interest rate at 2.75. But let's say, Riz, you bought your home in 2015. You paid for it 5 years, and now you can get a 2.75 rate, which is great. However, if you already paid 5 years in, let's say your mortgage was $1,000 a month. That's $12,000 a year times 5. That's $60,000. And out of that $60,000, 90% of all those payments are going towards interest. So you get a refinance, Riz, at 2.75, and you immediately violate a principle called the 50-25 rule, which means you go right back into a 30, even though you got a 2.75 rate, and you start all over again like a brand new purchase. However, what you look at, Riz, is that, wow, I went from $1,000 a month mortgage to $700 because 200 basis points would drop your rate almost $200 to $300, depending on the size of your mortgage, if it's $200,000. So you're excited about that. And the mortgage person is telling you you saved all this money, but what he or she is not telling you, because 9 out of 10 times they don't know, you just gave $60,000 up that you're never going to recoup. But you're going to pay $700 a month for your new mortgage, and you're going to start your 30 all over again. So there's a principle called the 50-25 rule, which basically means this. 50% of your term is based on the time in debt. And at the 50% rate, which is normally 15 years of a 30 Riz, you most likely, if you didn't buy the property on a discount like we normally do, best you would have 25% equity. But when you violated this principle to get that low 2.75 and roll back into a 30, you started all the way over at 0, just like buying a brand new house. So you have given up a minimum of $60,000, but you're happy because you don't know you just saved $300 a month.
Yeah, so they're showing you $300 savings, but in the back end you're paying more.
Exactly. So you're going to end up paying 3 times more for the house, but you feel comfortable because you got $300 less per month. So before your group does that, that's the reason why they should come to our webinar, because I'll explain in detail how the 50-25 rule impacts them. Now, let me tell you a positive story. We actually have a customer named Roz who was actually doing the same mistake. He came through our program. He got some coaching from us, Riz. We saved him $92,000 just 2 weeks ago by taking him out of a 5-year, term that he had paid for his house, put him into a 25 and got them the 2.75 rate, saved him $92,000. That's the way you do it the right way.
Wow, that's excellent. Another question I have is with the CARES Act right now, they're talking about 401k plans. There's a lot of people been getting laid off in Texas due to the oil and gas industry. Is it okay to take out would you recommend tapping into your 401k as a loan where you can pay? I think there's no penalty to take it out right now. I'm not sure. I just read something about that.
Okay, so
I'm not sure. I'm not sure about the details.
So yes, the law has been relaxed that there's no early penalty for the 401k. However, unless you're not in a true hardship, Riz, if you're not about to be put on the street and lose everything you got, no, you should not tap into your 401k. And here's 2 reasons why. Number 1, there's a rule called 72, which Albert Einstein discovered. If you take the interest that you earn and divide it into 72, it'll tell you how quickly your money will double for you. So let's take the example. The average person that has a hardship needs about $10,000. So if I were to take $10,000 out and I'm 40 years of age, Riz, and I were to take it out for 20 years, if I had a 7% return divided into 72, my money would double twice. I mean, not twice, but once every 10 years. So typically in a 401k plan, you're not touching that until at least 55 if you've done everything extremely right. But the average person is not touching that to 65, 72. So that's 25 years. Your money will have doubled almost 4 times. So that's almost equivalent to $80,000 for that $10,000 that you take out right now, because the CARES Act has relaxed the penalty so you don't have to pay it. But is that what you should be doing if you have not evaluated all of your scenarios? And again, let me give you a real life situation. I have a member who works for Southwest Airlines. She was told by her mother, you can take out money out of your 401k just 4 weeks ago. She took the money out. She came through our webinar 2 weeks ago. I sat down, ran a basic financial plan for her, found out she didn't even need the money. And it found out when I ran the calculation, Riz, she took out something like $15,000 and she's only like 28. It was going to cost her almost $140,000 in lost earnings at retirement. So we recommended to her, put the money back, and we ran a plan, got her debt under control, and she's A-okay right now. So before you do anything that you're hearing in the news and people are telling you about, get advice from the people who know what they're doing. Same way I did with you when you took over my energy account three and a half years ago, if that makes sense. So yes, you can take out without penalty, but no, you shouldn't unless you're about to lose everything you got, and that's your last result.
Okay, great. One last question I have is on life insurance. A lot of people talk about term life insurance versus whole life policy. Which one would you recommend on that?
Okay, so that's a great question, Riz. So all life insurance policies have a place and time depending on where you are economically and where you are in terms of your succession planning. Typically, the average person should only buy pure insurance when they don't have a lot of assets. Whole life insurance is really when you have accumulated a lot of wealth, because it's whole life. You pay for it until you die. Okay. So right now, if I don't have a bunch of assets and I'm not relatively old, I'm going to go with straight pure protection first, which is term. Now, if someone is your age again, that's 40, 35 years of age, good health, good credit, there's a policy called a return on premium that works kind of like a whole life. What it basically means, if I pay $100 a month, which is $1,200 a year, if I have that policy for 30 years, which is basically $36,000, and I'm still here, Riz, I get every dime back of the principal. I don't get any interest, but I get every dime back. At the end of the maturity, you can actually take that $36,000 check, and if you have accumulated all these great assets, you can buy permanent insurance at that point in time. So there's a place and time. And in our webinar, I actually teach people what's called the cost per thousand and how every different insurance product works. Whole life, variable universal life, index universal life, term, return on premium. But your agent only asks you 2 questions, Riz. How much you need, how much can you afford to pay?
How much you can afford.
Never buy on payment and how much you need in anything you buy. Cars, house, whatever, because if the people are not going to be doing right by you, they can trap you in a payment that will elongate the commission and the pain for you on the front end, if that makes sense. So we teach these things in our webinar called Family Finance 101, the basics of money. And you'll be surprised, Riz, I talk to people, lawyers, got MBAs and doctors, don't even know the stuff I just shared with you.
Great. Thank you very much. I really appreciate everything. That's probably all the questions I had right now. Those are 3 main questions I had. Is any questions you have for me right now, or?
Only thing I would have to say in parting, one, thank you for your time to enable me to show what we can do for the community, especially in your network of professionals is, hey, we want people to have a pom-pom lifestyle, Riz. That's plenty of money, peace of mind. We want them to come join us on the beaches of the World Club. And before they do anything foolish or unwisely, seek advice from people who have a proven track record. And what we've done, Riz, is that this is the third catastrophic event I've experienced in my life. 9/11, the 2008, credit swap, where we went to a real recession. And now I've made it through each one of those, and my income and my net worth has gone up, extending wise, because we had a foundation in place. So I would encourage people to come to our webinar. It's Family Finance 101. It's going to be brought to you by Riz, the electricity guy, and it'll be worth every ounce of dollar that you have to invest. And it's less than the price for two people to go to a movie and a dinner. So I thank you for interviewing me, Riz, and I thank you for your time, electricity guy.
Thank you very much. Thank you very much, guys.
Thank you.